Welcome to this session. In the previous lecture, we have covered some aspects of bank management. We discussed the liquidity management, and subsequently we have covered asset management. And today's session we will be discussing liability management and capital adequacy management. So, coming to the first part, liability management, it actually related to the acquiring of funds at low cost by the banks, and it also the liability management goes well along with the asset management as well, that is maintaining a balance between maturities of their assets and their liabilities in order to maintain liquidity and to facilitate lending, and thereby also to make profit. And recently liability management has gained more attention due to rise of large banks, especially money center banks. So, as a result of money center bank, expansion of money center bank, there is expansion of overnight loan markets, new financial instruments such as negotiable certificates of deposits, etc. And checkable deposits. As a result, the checkable deposits have decreased in importance as sources of bank funds. Let us now talk about capital adequacy management. There is a trade-off between safety and returns to equity holders. The capital, the equity capital. So, the benefit the owners of a bank by making their investment safe, that is one, is costly to owners of a bank because the higher the bank capital, lower the return on equity. We will be discussing this point in detail in subsequent discussion. So, there is a choice depends on the state of the economy and the levels of confidence in the economy. So, the overall health of the economy, the socio-economic soundness of the economy, it also depends based on that. Actually, all these factors matter in determining the trade-off between safety and returns to equity holders. So, capital adequacy, one of the key thing here is that ensuring sufficient capital, adequate capital, that helps prevent bank failure. So, the amount of capital affects return for the owners of the bank as well, and that is one. At the same time, from regulatory perspective, there is clear cut regulatory requirement of the required amount of capital in the bank, the proportion of capital to the total assets of the bank. So, let us examine these aspects by using a simple comparative example of two banks. One is keeping high capital, that is called high capital bank, and let us compare this one with another bank who is having low capital as compared to its total assets. Let us call it low capital bank. So, let us start this one looking at the assets and liabilities of this bank. Both banks having the total assets of 100, that the deposits reserves 10 million and loans 10 million, and for the low capital bank also we are presenting the same reserves and same amount of loans. And now look at the liability side. This bank having 90, the high capital bank is having $90 million as the deposits, and its equity capital is 10 million, that is the 10% of the total assets. That means you can see 10 million, or the total assets is 100 million. Now look at the low capital bank. You can see that this bank is having 96 million deposits, but the bank capital is only 4 million. So, in both scenario, look at this bank, that the banks with the high capital 10 million and bank having low capital, that is 4 million. Then let us see if there is some non-performing assets. So, in case of, because banks will be having lots of non-performing assets like loan, bad loans. So, in case of loan write off, if there is an NPA for them, so they have to write it off after certain period of time. So, suppose that both banks are having $5 million of bad loan, non-performing assets, and they have to write it off. In this case, let us see how both bank, how their capital helps them in preventing bank failure. So, coming to the bank that is keeping high capital adequacy ratio, that the 10%, then you know that when they are writing off 5 million, so now the loan became only 85, out of these 5 is already written off. So, what happened that they finance this loss by taking from this bank capital, that the 10 million, out of this now here actually this write off is taken by 5 million from bank capital, right. So, then they manage, you know that when there is a loan write off, actually this, if they, because of that suddenly their assets declining, and eventually one possibility is that bank may collapse. So, here the high bank capital, they could get 5 million they can easily take from their bank capital. What about the next bank, the small bank, small capital bank? Small capital bank, so if they had lost the, here they have to anyway they need 5 million here. So, 4 million obviously they can take from here, if suppose then they have to borrow as well. So, you can see that actually the bank capital is reduced to minus 1 million. So, in this case you can see that actually the bank is having deficiency of funds. What if this, suppose look at the bank, that low capital bank, suppose there is a deposit outflow as well. Suppose at that time the small bank, small capital bank cannot raise money because they are already having capital deficiency there, bank capital, there is a shortage. So, this is one thing, one reason why banks keeping more equity capital as proportion to their total assets, you know, that is in order to prevent bank failure. And because of this reason, this fact, the regulatory authorities, the central banks, they are also, because it is their interest, the central bank in the large interest of the economy, to ensure that there is a sound banking system. It is not at all at the interest of the economy and society to have banks getting failed. So, they want to prevent bank failure. So, because of that, one of the regulatory requirement is that the central bank will be asking the commercial banks to keep adequate capital with their in matching with their total assets. So, in the capital adequacy management, let us discuss some of the concept that is being widely used and applied while discussing capital adequacy management. The first concept is called return on assets. So, that means how the amount of capital affects the return to equity holders. So, the return on assets is the net profit after taxes divided by the total assets. So, ROA, shortly we call it ROA. ROA reflect how efficient the bank is, and is an important parameter for manager, because per unit of assets how much profit they are making. And then second, it is only secondary important for owners, because what they are interested is that not actually the net profit, the profit per asset, they are actually interested profit per equity, because an equity holder, a shareholder in a bank, for the most important concern for them is that per unit of share how much dividend they are getting, how much profit they are getting, how much dividend they are getting. So, in this case let us discuss the second concept called return on equity. So, here the return on equity, it means per unit, the profit after taxes per unit of capital. This is called return on equity, that the net profit after taxes per dollar of equity capital. And here this concept, that the return on equity, it reflects how profitable the bank is, because in the previous concept we seen that ROA, it reflects how efficient the bank is, that means per unit profit, you profit per unit of assets, but the return on equity, it reflects how profitable the bank is. And you know, obviously you know that this parameter is very important for the owners, that the shareholders of the bank. and then only it's important for the managers. So the shareholders, they will be looking how much profit they get per unit of share they are holding with the bank, right. So in that way this is very important for the owners, and the first one, ROA, is more important for the managers of the bank. So what we are seeing that later on in our discussion we will be linking these both aspects. You can see that what are the objective function of the managers and what are the objective function of the owners of the bank or the shareholders, that we will be discussing in our another context when we discuss conflict of interest concept in one of the subsequent sessions. So now let us look at the relationship between ROA and ROE. And actually based on this, because ROA we have defined that net profit after taxes divided by assets, and ROE, that the net profit after taxes divided by the equity capital. So what we can see that both can be, the relationship between ROA and ROE can be expressed by the equity multiplier. So the equity multiplier that we are going to write down here shortly, the amount of assets per dollar of equity capital. That means per unit of capital how much assets a bank can raise. So the ROA times EM, so we are going to write it like that, ROE is equal to ROA times equity multiplier. You can see here is that the ROE is equal to ROA times equity multipliers. So shortly you can see that the equity multiplier is the amount of assets per dollar of equity capital. So this is the relation, this is the equity multiplier, that the assets per unit of capital. So let us take an illustrative example with a high vis-a-vis low bank capital. So suppose assume that here a high bank capital bank, it is initially has 100 million of assets and 100 million of equity, and which gives it an equity multiplier of 10, that is 10 million divided by 100 million divided by 10 million, right. So the assets divided by the equity capital. So the equity multiplier here is 10. So let us look at another bank having same amount of assets, that the low capital bank, but it has only 4 million of equity capital. So you know that the equity multiplier is higher, equaling 25. So the low capital bank and the high capital bank having equal amount of assets having different equity multiplier. So that means the asset that they are generating by a given unit of capital, equity capital. So in this case, suppose these banks have been equally well run, so that they both have the same return on assets, for example 1%. Let us assume that each bank, both banks make a same return on assets, that is 1%. So now look at the return on equity for high capital bank and the low capital bank. So you know that the return on equity for high capital bank 1% times 10. So you know that this bank, the return on equity per unit of capital, the high capital bank is earning 10%. And what about the low capital bank? The return on equity for the low capital bank is 25%. And obviously you know that who is more happier? The equity holder in low capital bank are clearly a lot happier than the equity holders in high capital bank, because you know they are earning more than twice as high a return. And obviously you know that higher the dividend they are getting, and the share price, their stock price also will increase. So given the return on assets, the lower the bank capital, higher the return for the owners of the bank here. So in this case, from this we can also discuss another concept. Actually this equity multiplier, another name of this equity multiplier is the leverage ratio. That means with a given amount of capital, how much they were able to leverage, how much assets they are able to acquire. That means the leverage ratio is the assets divided by equity capital. So, in this case you can see that the equity multiplier, that actually the assets divided by the equity capital, this is called the leverage ratio, and the leverage ratio measures a bank's core capital to its total assets. The ratio uses tier 1 capital to judge how leveraged a bank is in relation to its consolidated assets. So, coming to the tier 1 capital, it represents a bank's common equity, retained earnings, reserves and certain instruments with discretionary dividends and no maturity. So, the tier 1 assets are ones that can be easily liquidated if a bank needs capital in the event of financial crisis. So, higher the tier 1 leverage ratio, higher the likelihood of the bank withstanding negative shocks to its balance sheet. The leverage ratio is used as a tool by central monetary authorities to ensure the capital adequacy of banks and place constraints on the degree to which a financial company can leverage its capital base. Let us now discuss the strategies for managing bank capital. So, one thing we saw here that if both banks, the example that we have taken, suppose both banks, the low capital bank and high capital bank, if both of them were able to generate able to acquire same amount of assets and able to earn same amount of same rate of return. So, in that case you know that the which we just covered now, we just discussed that means the low capital bank will be earning more profit, their shareholders will be more happier, a lot happier. So, sometime in that is the case, what actually read that sometime they need to reduce if they want to maximize profit, if they want to earn more profit. So, if that is the case, they have to reduce the size of the bank capital. So, to lower the amount of capital relative to assets and raise the equity multiplier, what they have to do, that one option is to reduce the amount of bank capital by buying back some of the bank stock, buying back some of the issued stock by the bank. That is one option. And the second option is reduce bank's capital by paying out higher dividends to its stakeholders. That means reduce the amount of the retained profit the bank is keeping, that amount they retain with the bank and distribute more dividends to the bank, so that the net total capital of the bank will be coming down. On the other hand, what if a bank is short on capital relative to assets because it does not have sufficient cushion to prevent a bank failure? In that case, the bank can raise capital for the bank by having it issue equity, issuing more share. And the second option is to raise capital by reducing the bank's dividends to shareholders. That means reduce the dividend, the distribution of dividend to the shareholders, so that it can become the part of retained earnings, and that it can put it into capital account as well. And the third option is to shrink the size of the bank. That means keep capital at the same level, but reduce the bank's assets by making fewer loans or by selling of securities and using the proceeds to reduce the bank's liabilities. So, in general, the third alternative of shrinking the size of the bank is opted, because raising the capital for the bank by issuing equity, it may not sound well, it may not go well with other shareholders. That means diluting the share, it will not go well with the shareholders, and similarly reducing the dividends to the shareholders, it also won't go well with the shareholders. So, let us now further discuss more about the credit risk and interest rate risk. These two concepts let us discuss in depth now. So, coming to the first part, managing credit risk, it is important part of asset management of the bank. So, importantly, we will be discussing the ways in which banks deal with credit risk. So, there are different options that banks use to deal managing the credit risk. That means when bank is making a loan, so at that time the credit risk, that the default risk the bank is facing. So, at that time banks use various tools in order to reduce the credit risk or in order to manage the credit risk. So, one of the thing is that screening and monitoring of potential borrowers. So, coming to the screening part, they screen the customers, the borrowers against the possible adverse selection. That means when the potential borrowers, the banks, with the best interest of the banks, the potential borrowers should be having should be low risk borrowers, they should be having low default risk. Ideally, zero default risk is highly preferred by banks. So, in order to do that, banks will be screening customers, potential borrowers, so that they do not have adverse selection issues. So, adverse selection issues means mainly the bank borrowers, those who are high risk borrowers, they have high tendency to borrow from the bank and then make a default. Then obviously, you know that as a result the bank will be having that unable to recover its loan, and then finally it will lead to, eventually it would lead to bank failure. And then comes the second part is specialization in lending, that means through information collection. So, you may wonder, because one puzzling feature of a bank lending is that a bank often specializes in lending to local firms or to firms in particular industries such as energy. So, one of the things that we discussed in the previous session is that bank should diversify, but at the same time now we are discussing that in order to manage credit risk, we also talk that sometimes banks specialize as well. So, what this actually a really little bit contrasting statement. That means in one instance we are saying that bank should be diversified its portfolio, and now another instance we are saying that they are going to specialize in lending. So, in one sense this behavior seems surprising, because it means that the bank is not diversifying its portfolio of loans and thus is exposing itself to more risk. But from another perspective, such specialization makes perfect sense. You know how? Because the adverse selection problem, it requires that the bank screen out bad credit risk. It is easier for the bank to collect information about local firms and determine their credit worthiness than to collect comparable information on firms that are farther away. So, similarly, by concentrating its lending on firms in specific industries, the bank becomes more knowledgeable about these industries and is therefore better able to predict which firms will be able to make timely payment on their debt. So, it was the borrower has an incentive to engage in risky activities that make it less likely that the loans will be paid off. To reduce this moral hazard, financial institutions must write provisions, that is restrictive covenants, monitoring and restrictive covenants into loan contract that restrict borrowers from engaging in risky activities. So, by monitoring borrowers activities to see whether they are complying with the restrictive covenants, and by enforcing the covenants, if they are not, lenders can make sure that borrowers are not taking on risk at their expense. So, the need for banks and other financial institutions to engage in screening and monitoring explains why they spend so much money on auditing and information collecting activities. So, another component is long term customer relationship, building long term customer relationship. If a prospective borrower has had a checking or savings account, a loan with a bank over a long period of time, a loan officer can look at past activity on the accounts and learn quite a bit about the borrowers. The balances in the checking and savings accounts tell the banker how liquid the potential borrower is and at what time of year the borrower has a strong need for cash. A review of the checks of the borrower has written reveals borrower's supplies as well. If the borrower has borrowed previously from the bank has a record of the loan payments as well. Thus, long term customer relationships reduce the cost of information collection and make it easier to screen out bad credit risk. So, the need for monitoring by lenders adds to the importance of long term customer relationship. So, if the borrowers has borrowed from the bank before, the bank has already established procedures for monitoring the customers. Therefore, the cost of monitoring long term customers are lower than the cost of monitoring new customers. And in the next session, we will discuss some more aspects of managing credit risk that include compensating balance, credit rationing, etc. Thank you.